Hello, my name is Shelby Wilson, and today I'll be analyzing two industries, the restaurant and e-commerce industry over time and relative to incumbent firms. For the restaurant industry, we'll be looking at Jack in the Box, Sonic, Yum Brands, Wendy's, McDonald's, and these are all fast food chains, except Yum Brands includes KFC, Pizza Hut, and Taco Bell. For short-term solvency measures, we're seeing how well these five companies can pay off all of their short-term loans. McDonald's has the highest current ratio, followed by Wendy's, and these are also the only two companies whose is above 1, and the average was 1.5 for the industry. Sonic was getting pretty close, but the others are far below that. And as you can see, McDonald's is moving in a good direction. Over time, Wendy's is starting to do better. Sonic's is going down, which is not a good sign, and then Jack in the Box and Yum Brands has stayed around the same for the past 5 years. For the quick ratio, we're getting rid of the most liquid asset, which is inventory. McDonald's is still very high compared to the industry average, and so is Wendy's, and the others are decreasing. Now for the cash ratio, we're going to be only looking at how much cash they have on hand to pay off their short-term debt, and Wendy's and McDonald's is once again far above the average, and so my conclusion for this is maybe they could be better investing their money instead of keeping it, since it is so far above. Now we're going to be looking at if these companies can pay off their long-term debt. For the total debt ratio, the average in 2015 was 60.64, and none of these companies were too far away from that, and all of these have stayed pretty much the same, except they have all increased in 2015 more than the other years. For debt to equity ratio, Jack in the Box has a lot of creditors paying for things as opposed to shareholders, and so does Sonic, because those are both well above the average of 1,641. And then the other three are below it, so that is a good sign. For the equity multiplier, we can't do much with this until we do the dew point analysis. But from this, we can see that Sonic's is definitely the highest, and then the rest of these are pretty close to the average. And you can see right here too, nothing much has changed over the past 5 years, except in 2010. Sonic's was all the way to 87.76, so not too sure what happened there. For the time interest earn ratio, we're seeing how many times they can pay their interest over, and as expected, McDonald's is the highest, and these have all stayed the same over time, except for Yum Brands. Theirs has went down by a lot from 2012 to 2013, so maybe that's why they didn't report anything for 2014 to 2015. Now for the cash coverage, we're getting rid of depreciation, and now surprisingly, Jack in the Box is the highest, followed by McDonald's, so the favorable company would be Jack in the Box. And then Sonic's is well below, and so is Wendy's. Now we're going to do the DuPont analysis, efficiency, and profitability ratios. For Jack in the Box, their profit margin was 7.04, and they had a 1.20 asset turnover, so they are operating efficiently, and as you'll see later on, they're one of the only companies in the restaurant industry whose asset turnover is above 1. And then for the leverage ratio, theirs is still high at 9.40, and that's what's driving the return on equity to 79.42. For Sonic, they had a high return on assets for the industry, but they are definitely relying on their equity multiplier or leverage to drive this return on equity higher to 158.85. For Yum Brands, they had a pretty high profit margin after doing some math to figure that out. And I forgot to mention earlier, I did my own calculations instead of just relying on Bloomberg to make more sense of the numbers. And it was all pretty close to what Bloomberg had for the return on equity. But their leverage ratio is at 6.68, which is a little high for the industry, and that's driving the return on equity higher. For Wendy's, they are not relying on leverage to drive it higher. They have an around average profit margin, and then their asset turnover isn't too good. It's low at 0.45, and that led to a low return on equity at 11.08. Now for McDonald's, they're using less leverage than the other companies and having a higher profit margin, and this is why the return on equity is now at 43.54. Now we're going to look at market value and analyst opinion. So for economic value added, clear winner is McDonald's, and that's because their NOPAT is high. And then the other ones are still above 1, which is a good sign. And then Yum is in second. Wendy's, Sonic, and Jack in the Boxes was all around the same. For the price-earnings ratio, all of these haven't changed much over time within each company. The average was 24.02, and they were all pretty close to that. And the favorable company would be Jack in the Box because they have the highest, and that means that the market believes that they have the most growth potential. Then for a market to book ratio, Jack in the Box is really high, which we're going to see in a few minutes. They are overvalued, but my favorable company would be Wendy's, and this is based on the dividend discount model, which is right here. They are undervalued by around $7. Sonic is undervalued too, but only around $1, so actually they're more fairly priced. And then Jack in the Box, Yum Brands, McDonald's were all overvalued. According to the analyst opinion, they think Jack in the Box is the strongest buy, followed by Sonic, then Wendy's, then McDonald's, and Yum Brands. And I agree with Wendy's maybe not being a strong buy, but I think they would definitely be a buy because they are undervalued. And then Jack in the Boxes, I would say, is more of a hold because of their poor financial performance. For the supply chains, nothing really stood out here. A lot of the restaurants are going to have some of the same suppliers because of where they're getting their sodas and whatnot from. And the only thing that really stood out was that how many more suppliers McDonald's has than anyone else, but that makes sense since they're all over the world. And then based on my findings from these 5 ratios, I would invest in McDonald's because of their consistent positive financial performance over time. Now we're going to be analyzing the e-commerce industry. We'll be looking at Cafe Press, Overstock, eBay, Amazon, and Netflix. And let's see if these companies can pay off their short-term loans. For the current ratio, these were higher than the restaurant industries. Cafe Press, where are you? Cafe Press is second highest. eBay is the highest. Amazon, Netflix still above 1, which is a good sign. And then Overstock is below 1, which is a bad sign. eBay and Cafe Presses are increasing. The other 3 are staying pretty constant. For the quick ratio, Cafe Press is still second, eBay is still first, and now that we got rid of inventory, the other 3 are all below 1. For the cash ratio, eBay and Cafe Presses I think are a little high for the industry. Once again, they need to invest their money into something. And then all the others are still below 1. Now we're going to see if the companies can pay off their long-term debt. For the total debt ratio, eBay's was the highest, but that's not going to be necessarily a bad thing because they will be able to pay off their long-term debt. And then Overstock and Cafe Presses is the lowest, and then Netflix is in the middle, and Amazon. But then for debt to equity, Amazon is taking a lot of money from creditors compared to shareholders, and theirs is the highest, followed by Netflix, and then eBay, and then Overstock, Cafe Press, and then it's obvious an industry trend is all these are increasing, but Amazon's is slightly decreased. For the times interest earned ratio, we're seeing how many times over they can pay their interest. And then the average was a negative 16.81 for 2015, and this is because Cafe Presses was a negative 99, and this drove it a lot lower. Overstocks was also negative, this is a terrible sign of financial performance, because this means they can't even pay their interest, so how are they going to pay shareholders and even creditors? And then Amazon and Netflix are both above 1, and he's at 15.26. So it seems for the e-commerce industry, it's okay to have a lower times interest earned. Then for cash coverage, now all of these are positives. Now they got rid of depreciation, so something is going on with Overstock's depreciation, because theirs used to be negative, now it's at 175. Cafe Press is also positive now, but all of these are still pretty low. So for the equity multiplier, none of these were far at all from the average. There wasn't anything that really stood out right here. And now we're going to look at the DuPont analysis, efficiency, and profitability. So for Cafe Press, their operating margin was negative, and so is their tax burden. So I'm guessing they're paying a lot in taxes, and this is why I got a positive 2.13 for their return on equity, and Bloomberg had a negative 6, which I'm not sure how they got that, but it's still very low for the industry. And then for Overstock, I got a negative 0.21 for the return on equity. Bloomberg had a positive 2.26, and then I think this is because according to Bloomberg, their return on asset was higher, but this is driven lower mainly because of a negative profit margin. Operating margin. For eBay, they had the highest return on equity. They're not using too much leverage. Their asset turnover is low because it is below 1, but their profit margin is high at 17.30. For Amazon, their return on equity positive, which is a good thing, but what's driving theirs is their leverage. It's pretty high, higher for the industry at 4.97. For Netflix, their return on equity positive 6.74, around average profit margin, around average asset turnover. Now we're going to look at market value and analyst opinion. For economic value added, by far, once again, like in the restaurant industry, there was one company that stood out, and for this one, it is eBay, and the other ones were negative, which is not a good sign. For the price-earnings ratio, the market clearly believes that Amazon has the highest growth potential, but in this project and in past projects, when I analyze Amazon, they don't have very good financial performance, which is why, according to this, they are the favorable company, but I do think they are overvalued. In the market to book ratio, Amazon is the highest as well above the average of 10.746, so they would be the favorable company. And for the dividend discount model, a minute ago, I just said that Amazon was overvalued, but according to this, it is fair when you do the calculations. And then Netflix was overvalued, Overstock is overvalued, and eBay is fair. For the analyst opinion, the market believes Amazon has the highest growth potential, but Amazon's financial performance is not reflecting this, therefore I disagree. And I agree with the other opinions because the dividend discount model is close to the market price. For the supply chains, Cafe Press didn't really list anything. Overstock had 8 suppliers. eBay, this is why I think they're a good company too. They have 42 suppliers and 4 customers. And then Amazon is the largest at 204 suppliers and 16 customers. And then for Netflix, 56 suppliers and 8 customers. And none of these had a lot of the same suppliers and customers. But my final conclusion is eBay would be the best company to invest in because of their high return on equity, without having to use too much leverage, and also because of their high liquidity ratios. But the best company to invest in out of the 2 industries is McDonald's because they have the highest return on equity compared to eBay and the best liquidity ratios, which is the foundation for profitability and is going to lead in the future to a higher market value. And thank you for watching.